Going, gone. All the gains the iron ore price made this year have now been wiped out. As you can see, the crunch has come in the last week, where it's lost a fifth of its value. It's now 50% cheaper than at its peak last year. Now, a lot of the run-up in the iron ore price was pinned on hopes that China would see a swift economic rebound from all its lockdowns. But Chinese consumers are not buying it. Confidence has dived to levels not seen in more than 5 years, and sales are at peak pandemic lows. And in another not-so-good sign for China's major trading partner, us, China's imports and exports are dropping sharply. Despite all this, Chinese markets rose today, led by real estate stocks after property sales bounced by up to 30% in big cities. So it all depends on your perspective. Tanking iron ore prices, though, meant our market had little hope of making gains. The big miners were walloped, Fortescue the worst of the big names. So the All Ords closed off 0.8%, and the Australian dollar is still sitting sub 70 US cents. Now, the R word is now becoming much less of a taboo and more a fait accompli. Roughly 4 out of 5 leading US economists expected recession next year, and now the markets agree. As this chart shows, the last 4 recessions have been preceded by the US government bond yield curve hitting zero. And look where it is now. That red line, which is US GDP, is headed for sub-zero next year. Speaking of sub-zero, the crypto crash continued over the weekend, but there was a little rebound today. Here's a look at Bitcoin and Ethereum, which together make up 75% of the crypto market. Bitcoin fell below 20,000 for the first time since late 2020 over the weekend, before mania took over. That's finance.